Hello, everybody. Welcome to Dealmaker Atlanta's online webinar series. I see we've got some great people in the pre-waiting room in YouTube and should be feeding into Facebook here shortly. Super glad to have y'all here with us tonight. We're going to spend about the next 1 to 2 minutes just kind of hanging out and waiting for everyone to arrive. But before we get started, Tiffany, you want to introduce yourself, or would you like for me to introduce you?
No, you introduce me. Do it.
So back when we started our podcast, I would start it off with, welcome back to the On Purpose Investor Podcast. I'm your show host, Eric, with my amazing, beautiful Wonder Woman, super amazing, beautiful, blue-eyed, red-headed, amazing wife.
Okay. Thank you, Tiffany.
There it is.
I was like, is it going to stop ever?
It never stops, ever stops. Tiffany and I got started in real estate investing almost 7 years ago now, maybe 8 years ago. And it all started when I had a property I moved out of and moved in with my dad. It was a unique situation there. And my second date with Tiffany was her helping me move. And shortly thereafter, she discovered how horrible of a landlord I was and decided we needed to educate. So we started attending a meetup in Fayetteville, Georgia at the local IHOP. Love them pancakes. And just sat in the room and soaked it in and really tried to figure out what is real estate investing, what is all of that. And Tiffany really took the bull by the horns and said, you're leaving your job. I was like, okay, I'm not going to argue.
Well, you were teaching, and we realized really quickly we could flip a house and make 1 to 2 years your salary in 20 hours of work versus how many hours a year were you working?
Oh boy, hours a year?
Yeah.
Or hours a week?
Yeah, I mean,
hours a week. Hours a week was 70 to 80, from July until December. And then January through June, it was about 45 to 60 hours a week.
Right. So you didn't get like the teacher breaks.
No.
I'm not saying that teachers get like tons of time off because you're doing stuff, but
right.
You were working your butt off. So
I was. But tell everyone about yourself and tell everyone why you are qualified to talk about financial anything. What makes you so qualified to talk about financial anything?
Yeah. So in building a real estate portfolio, I realized our superpower was my financial knowledge. And I know you agree with that 100%.
Mm-hmm.
We built spreadsheets. Well, when I say we, I mean I built spreadsheets and forced Eric to look at them.
Mm-hmm.
And one of the things we were super clear on is what our number was and how many houses we had to have to be clear on how to get to that number.
Yeah.
So my background, I have an undergrad from Georgia State in finance, got my master's from Georgetown in finance, and I worked never in finance officially, which is hilarious. But I did a lot in data and analytics. So taking lots of data and making it into something that a layperson could understand. And my superpower is taking complex stuff and just breaking it down into something that's tangible to your average person. And through a lot of years of working with Eric, I have mastered that skill of dumbing stuff down.
I need it as, caveman as you can get it. That's where I need it. Draw it out on a rock wall. I'm good.
I see a comment from Dakota, 20 hours to flip a house.
So that's 20 active hours of me. That's 20 active hours of my involvement, of making phone calls, of scheduling, of meeting someone at the house.
And it was a lipstick.
It was a lipstick flip. It was during 2019, maybe 2021.
It was COVID. It was during COVID, and it was a lipstick flip that we got as a referral through his brother.
Yeah.
And it was so easy. And the longer it took for stuff, the more money we made because prices were just skyrocketing.
Yeah. I wish it had lasted another, 6 months because that would have gone up another 50, 60,000.
Also had 2 cars to sell from that and found all kinds of fun replicas of body parts that you don't want to talk about. So
yeah, we'll save that for a meetup one day. Legends of stories of things you found in a rental property. Yes. We'll put that as a deal maker topic one day.
Yeah.
So I just want to show a couple people here. We've got James. Thank you for being here with us tonight. And Dakota, if you're not following the outdoor agent, Dakota, I don't know how to say your last name yet. Oshlisley? Oslis.
Just stop
Maybe
while
you
you're
can
behind.
phonetically comment that. Welcome to the show. And Josh Boyd, my partner in crime with Dealmaker Atlanta. Thank you for being here tonight, buddy. And just, Shelly. Yeah, you made it super easy. Thank you. Appreciate that, Dakota. But y'all, tonight, Tiffany is going to dive into a mindset around wealth, a mindset around taxes, a mindset around keeping more of what you make. So, Tiffany, do you want to kind of give an overall view of what that means?
Yeah. Well, I want this to be an open Q&A for the majority of the time. So I know, Dakota, you sent a question ahead of time, so definitely want to address that. I do want to start with the standard disclaimers. I don't have licenses. What does Danny say? Other than a marriage license and a driver's license. So
That's it.
A lot of this is coming from a layperson perspective and my finance knowledge. So I'm not a CPA, not an attorney. So anything you hear today is just for entertainment purposes and all the other legal stuff I'm supposed to say. So definitely want this to be more Q&A, just like throw all your finance questions at me. I know Josh and I've had extensive conversations around bookkeeping. Dakota sent a question around entity structuring, so we'll get to that. Just to start, I want to give my framework around wealth and the stages of wealth. And it's really helped us get clarity on kind of where we are. And honestly, looking at it makes me feel a little better, because there's times you're like, holy crap, I'm not where I want to be. But then when you look on the scale, it gives you just some, I don't know, comfort to see where you're at and a clear path of where to go next.
Welcome, Todd and Leslie. Glad to have you here. All right.
All right, switch me.
All right, let's go. Let's talk about these wealth stages.
All right, so there are 8 stages. So we start with step 1, clarity. If you want to zoom in so that I can see it, maybe. There we go. So clarity is, your personal P&L. So that means you know how much income is coming in, how much you're spending, and exactly how much you need to make. And I have a podcast episode coming out on finding your number. So if you want that info, reach out to us. So that's the first step, is just your numbers. Next, we have survival. So you live paycheck to paycheck. Nothing extra at the end of the month, but you can cover the basics. Then we have sufficient. So you can cover the little bit extra. So in Danny Williams terms, step 2, survival, is your rice and beans budget. Step 3, sufficient, we're like in ground beef level. Step 4, we have savings. So we have a 6-month emergency fund, no consumer debt. We're kind of in a comfortable place. And then step 5 is what I call Danny's steak budget. So you have enough to cover all the extra stuff you want to do. Then we get on to step 6. So 2 years of your annual expenses invested. So you take, let's say you're spending $10,000 a month, 12 months a year, that's $120,000. So at that level, if you're spending $10K a month, you have $240,000 in real estate terms, I would say a net worth. When I'm calculating net worth for things like this, I like to reduce it somewhere between 5 and 10% of current market value to account for, if I sell this, I'm paying an agent, and that's kind of my true take-home cost. So just something to note. And you never know what prices are going to do. So I like to be a little conservative.
Yeah.
Step 7 is investor. So it says dividends. This is kind of tiered towards stock investors and real estate investors. So I would say dividends or cash flow is equal to your annual expenses, or 8 to 10% of your invested assets are equal to those expenses. So if you're invested in the stock market, typically you can get somewhere between 8 to 10% of an annual return. So that would cover your nest egg that you need. And then aptly named step 8, FU money, 30 times your annual expenses invested. And that's when money just kind of doesn't matter anymore.
Yeah.
So I love this framework as a starting point for questions and conversation, because we can talk, like if you're in stage 4, we can talk about debt payoff plans. We can talk, like anything financial is open book. We can talk expense reduction. Like I said, I've talked to Josh a lot about bookkeeping and where does stuff go. And I do have a demo of REI Hub pulled up if you guys want to look into that. We can chat through like how that looks and works. But I want to start with Dakota's question, and then any other questions that you guys have that you want to throw in there, we can definitely cover. Okay. You want to read it for me?
Yeah, so Dakota's question is, what's the best way to structure your business for tax sheltering? This is not tax evasion. This is tax sheltering, right? Let's say you have some investment properties and one or multiple entities and another source of income. So you are an investor, but you have a W-2 as well, right? Or a side hustle. Roll them up into a holding corp, S or C, right? I'm sure that's a big ball of yarn. That's case specific, but it may be worth talking about.
Yeah. So again, not a CPA here, just have a lot of finance knowledge. Leave that up so I can keep referencing it. So the way I like to look at it is my investment properties are going to stay completely separate from any other kind of income. So in our entity structure, we need to make some changes, but we have our rental properties on one side. What are you doing? You're messing with me.
You're good. Keep
All
going.
right. We have our rental properties on one side, and that all folds up into our real estate. So whether it's one entity or 5 entities, doesn't really matter. I mean, it does matter. You want to make sure you're not, I would say, have no more than $1 million of equity per entity. It's probably lower than that for a lot of us. I want to say we have like 250 or 350 per entity.
No, it's like 550
Okay.
per entity.
The logic we have on having multiple entities on the real estate side is we cover with umbrellas. We kind of go into this with an assumption that our veil is going to be pierced. We try to do everything we can to protect that, but there's an assumption that someone potentially could find something and pierce the veil. So the entities don't matter. But we use a lot of umbrella insurance. And again, this is just what we do, not advice. But we have them spread across a bunch of LLCs. And the thought in having it spread is not from an asset protection perspective for us. It's if we get sued and our assets get frozen and we can no longer touch the rent coming in for those properties, but we still have to pay that mortgage. We want that to be for just a handful of properties and not the whole portfolio. Because I mean, we don't have the reserves to survive a lawsuit of that, caliber across the whole portfolio.
Can you explain a little bit? You said piercing the corporate veil.
Yeah.
Maybe a term people haven't heard before. Can you explain what does that mean?
Yeah, there's a really good book. It's one of the Kiyosaki guys. I cannot think of it. Veil Not Fail. Something like that. Eric's looking it up for me. That digs into this in a very, Veil Not Fail. By Garrett Sutton. Mm-hmm. It's a great book on just understanding how to protect yourself. The idea is if you treat your LLC like a personal entity at any point in time, they can potentially say, hey, that's not really a true business entity and you're just using it to pass through personal stuff. So you lose that protection that the LLC provides. So,
yep.
Cool.
And I just put that link in the comments. So if you want to go read that book or grab the audiobook, I'm not sure if they have an audiobook. That'd be some great food for thought there.
Yeah. And it's not like the most boring legal book you've ever read. I've read the boring ones too. So,
yeah.
Okay. So that's the one side on the real estate. Well, you're scrolling.
Oh, sorry.
Okay. Fun working with your spouse. So have it multiple entities, whatever you want to do for the real estate. Next to it, we have our S Corp. It could be an LLC. Talk to your CPA about the right time to switch from an LLC to an S Corp. The only time I personally would use a C Corp is if I'm doing a ROBS, which is a
rollover business startup.
Yeah, for retirement accounts.
Yep.
And you have to use a C Corp there. So I don't know a ton about it. The guidance we've been given is S Corp when you hit a certain threshold of income. So for us, like we have one roll-up S Corp for our businesses. That's our flips. It's any kind of active income. So like my financial coaching business, anything for On-Purpose Investor, that all falls up into a holding company. So we have the S Corp holding company, and then down here are 3 or 4 other LLCs that roll up into it. So we're only filing one S Corp return. I know some people will file 2 or 3 or 4 S Corp returns. They get more expensive because there's more involved in that from an accounting perspective. So that's just been our approach. So when you look at our big grand entity map, we have the rentals with sub holding LLCs, the S Corp with sub LLCs for each business. And then up here at the top is a living trust. And that keeps us from having to go into probate if something happens to us. And then we have a will that is for like our personal property. So we have our house and our cars and all the crap in our house that falls under the will.
Yeah.
I think that covered it.
All right.
But Dakota, chime in if there's anything else, any questions on that.
Yeah. And we have a follow-up question here from James.
So we have an LLC, and I want to say we have 3 million total with between our umbrella and our GL on our properties. That I don't know why we came up with that number. That's just kind of what we came up with. So
we recently did have a conversation with an attorney that has been kind of helping us with some structuring, recommend that we go from 3 million to 10 million. So that is part of the conversation. So I think it's all based on your risk tolerance. And, I think a lot could be said about, where your rentals are located, what kind of tenants are you renting to, just getting a risk profile of your portfolio and assigning an umbrella to cover whatever you calculate that risk profile to be. So I think that could be helpful.
To add to that, when we're designing the entity structure for the rentals, all of the pad splits are in one entity. All the Airbnbs are in one entity. And then we kind of broke it up by risk of the property type. So we have some that are in great locations. We have some that are in okay locations. So the ones that are in more okay locations, we put those together because we felt like there is a different risk profile than our A properties.
Yeah.
So I don't think it really matters as far as sole proprietor. I mean, we all know a gentleman in town that has 500 houses, or is he down to like 3
He's
now?
down to 200, I
Okay.
think. Yeah.
Oh man, must suck. And he does everything in his own name. So I think at the end of the day, I don't think it really matters. We kind of did a yes and have the LLC plus umbrellas. We're actually looking at new insurance, and she's like digging to find all the umbrellas that we have on top of umbrellas. So
yeah. Yeah, I would say don't overcomplicate it, especially in your first, 5 deals or so. Just get the ball moving. Just get it rolling. Pick your lane, stay in it, build that bridge to Dream Island, and stay on that road. And once you get to a point to where you are, feeling comfortable with your cash flow, then start talking about, structuring and stuff like that. And I'm sure there's a whole other train of thought of structure it first and all that. But from a lot of things that I've heard and read and just listened to, it's when you start up a business, a lot of people want to jump to making the logo first. Like, I need to know what the logo is, or I need to know what the name of my company is. No, you need to figure out what problem it is you're solving and get really clear about who your avatar is, and knowing who you're selling your product to, or, what is your perfect house, your buy box, figure that out first, and then go name the company later.
Well, get the clients and the revenue.
Right.
And then, yeah.
So don't put the cart before the horse.
Yeah. I mean, we have changed our entity structure 2 or 3 times over the years.
Yeah.
Because we took blanket advice in a situation similar to this and just applied it to ourselves. It was a very different strategy. And we realized it just doesn't work for how we've built our business.
Yeah.
So then we unwound that and then redid it I think we've done 4 different structures.
Yeah.
Until we finally landed on what worked for us. So.
If anyone tried to sue us, they'd probably be very confused about the chain of custody of the deeds.
Yeah.
Because it went to a trust, then it went to an LLC, then it went into a different kind of trust, and it went back into an LLC. It's like, well, who actually owns this?
I don't even know what we did. And I did it all. So
yeah. Dakota, I want to give you props right here for asking the big dog questions of, you are soaking up knowledge right now. And I think more people should be where you are of attending these things. I remember the very first webinar we attended with Brandon Thompson, Brandon Turner, and he was talking about how to run numbers on a deal. And I felt so small, right? And I asked a question and he answered it. And I was like, oh my gosh, he said my name. But it was just one of those things where I just wanted to soak up the knowledge and just be in the room. I keep saying that. And Chuck Glover keeps saying that, but being in the room matters. Being in the right room matters even more, but you might have to kiss a few frogs to get to the right one.
Yeah.
So Dean says the confusion actually sounds like a good strategy. Yeah, it's not a bad one. You know, right. My son has figured out the phrase wild goose chase. And today he asked me, Dad, what is a wild chugodecase? I said, you mean a goose chase? He said, no, a wild chase. Oh, a wild goose chase. Got it. And then, you know, as I was explaining our chain of custody on our deeds and stuff like that, I was like, that is a wild goose chase. So yeah, maybe the confusion is a good strategy. Anyways.
Which kid?
That is OTTO.
Oh, the old one.
Yeah.
Oh.
Thank you, Dakota. It would be a great flow chart and it would be scribbles.
Yeah.
Thank you for sharing that. Tiff, do you want to jump over into REI Hub? Or do you want to?
We can do that. We can talk through like debt repayment strategies.
Okay.
Like when's the optimal time to pay off houses versus continuing to build? Or really any topic that anyone wants to chat about.
Yeah. So I think what we do is we start explaining a little bit about REI Hub and people let your gears be turning. And if you have a question that comes up, any kind of question at all that comes up, it doesn't even have to be financial. It could just be like, hey, what's your favorite color? Go ahead and ask that and we will get to those questions. So we're going to let some questions pour in and then we'll come back to it after we talk through REI Hub. You want to get to Josh's?
Yeah, we'll do Josh's real quick.
All right.
You can start switching or you already did it. Never mind. Look at you, all tech savvy.
Yeah.
So Reggie taught him to be careful what you name your LLCs as well. They have names. You have to work to figure out that they're his. Go ahead and tell the story.
So Tiffany was pregnant with our first, I believe, when we started getting into the interesting idea of grouping properties into different LLCs. And at that time, a big craving was ice cream. And we started listing off, hey, what are our favorite ice creams? And that landed into LLCs. And we ended up owning four different LLCs. We had Butter Pecan Properties LLC. We had Moose Tracks.
No, we had Cookies and Cream, Creamsicle, Butter Pecan, and there was one more.
Yeah.
Rocky Road
Properties.
And the funny thing is our bill pay for some reason got stuck on one of them. So every time we send our lenders a check, it says like Butter Pecan Properties
LLC.
Yeah.
And the entity that owned all of that was Ice Cold Properties LLC.
Yeah.
That was the name of the holding company that held those LLCs.
Yeah.
So, yeah.
You gonna share that?
Which one?
Dakota's.
Yeah, we'll share.
That's what
Dakota's.
You were laughing at.
I didn't understand it.
Nunya, like Nunya Business.
Has Nunya LLC. Got it. I like it. It took me a minute. I'm very dense, y'all.
Okay.
It takes me a long time to get jokes.
It does.
All right, so we're going to jump over to REI Hub, and please keep the questions coming in. And we're just here to chat. We're here to educate and learn together. Yeah. So let's talk REI Hub.
Okay, so
do you want to drive it?
We'll see. I'm not a Mac person, so we'll give me some grace. So REI Hub is the tool we used before we switched to QuickBooks Online. And we switched to QuickBooks Online because tracking our balance sheet got a little out of hand and I just wasn't keeping up with it. And there was a lot going on in the business. So
Hopefully the volume's back now.
Oh,
There we go.
was I just talking to
You were
no one?
talking. So
Oh.
start back over at this is a demo account.
Okay. This is a demo account.
There we
so
go.
if you want the link, I can send it to you. So this is our iHub. We have cash flow. So this is like the net after everything. And to be honest, like one of the things QuickBooks does that I don't like is it doesn't give a true cash flow number. If you want a full explanation of that, I can give it to you. But for simplicity purposes, this is cleaner to me. And then it has net operating income. So this is rent collected. So like this would be really helpful for us to see right now with Airbnbs of like how much rent's coming in. You can see your properties and get details on those, the total portfolio value versus the debt and equity. And we can see our expenses and like how that breaks down and so on. So what I love is we should be tracking our expenses. And I know we don't always do that. So you can come in here really quickly and see all the expenses that need to be reconciled or booked is the terminology they use, and just come in and book them to whatever account they need to go to, a description, and then you can assign a property. I'm not going to save these because it's their demo account, but you can also create rules to automatically book. So when we pay a lender, let's say it's a flat $150 a month to a certain person, I can come in and set a rule, which I guess they have some in here. It's kind of cool. So if the name contains Dominion Electric, they're going to throw it to this property. So it can help save some time. But you can also go in and record your loans and the escrows and link your mortgage account in here so that it's automatically updating every month. The Airbnb feature is new. I have not seen this, so I don't know anything about it. But the other thing I really liked is it produces a Schedule E. So hopefully I guess I have to pick one. Where did that go, Eric?
Where's that?
Oh, no, it's here. Okay. So you can quickly see what it looks like on the tax return. So I just think it's simpler because we're looking at the tax forms. Most of us are not looking at it in like P&L terms, and it can track depreciation for you as well. And there are tons of reports. You can come in. If you want to see the P&L, you can see it. You can see it by property, which I guess there's no data for this year, but I'm looking around your mic to see.
Yep.
I love this, being able to see how much the market value and loans, the equity per property is. It's a clean, simple tool that makes it pretty easy. And then you can also do your mileage log in here too, if you want to track it. You can track vendors for 1099s and then assign those expenses to that vendor within here, and just makes it a little bit easier. I personally never tracked leases in here just because we have it in our other, Rent Ready. So that is kind of the overview. I guess we can go into the properties. So you can see per property what's the income, which is something, if you're not doing this on a regular basis, you should be. Just looking at what is the true cash flow per property at least once a year. So you can get a feel for how much are you truly making on that property. We recently did one. Are you good with me sharing this?
That's fine.
We did a deep dive and realized one of our pad splits is basically making the same amount that it would as a traditional rental. So we've made the decision that we're probably going to relocate the members into empty rooms we have in another pad split and shut that one down and just convert it as a traditional rental, because we'll make the same amount and not have multiple tenants. We just have one. So it's helpful to do that analysis at least once a year. But I love just having a clear picture of the equity in the house, the income of the house. You can add notes in here too if you want to keep track of, any kind of documents related to the property and so on. So, any questions on REI Hub? reading through the comments. Are you looking for the link?
Mm-hmm.
I have it.
Where?
In my Facebook or something. Okay. Let's see. Josh said he just started using it and loves it. I think it's user friendly and easy to use. And just like this feature with the transactions is so straightforward that I don't know, I'm just a fan. So it does not do forecasting. That is stuff I do in my spreadsheets outside of here. And that's something particularly with the Airbnb, we've started doing more forecasting because, you know, it's not the same amount of rent each month. So it does not do forecasting, unfortunately. All right. So we're going to go up to Silken's comment now. And if you have other REI Hub questions, we can bounce back. Do you want me to switch back to this?
There you go.
Okay. I'm figuring this out. Debt repayment strategy. So how do you know when you should start paying down debt? Do you want help?
I'm just trying to find it.
Okay.
It's not working because you're in my.
Oh.
Just get on your phone and send it to me.
All right. Talk about when you would pay off for debt.
Let me get into this way of thinking. So debt repayment strategy. I like the idea of like basing things off of risk tolerance. So when you have a W-2 income, your nest egg is essentially your job. And when you're switching out into full-time real estate investor, your income comes from cash flow. And you lose sort of that guaranteed money but from a W-2, but oftentimes it's not that guaranteed. So I think it comes down to what do you want your emergency fund to be and how much do you want it to be? Do you want cash in the bank? Do you want cash in equity? And I feel like I would rather have cash in equity mixed with cash in the bank. And so I don't feel like I would ever really want to pay off a property fully unless the property is A, underperforming, or B, I could use the equity sitting in that property at a higher return than where it's currently sitting. And Courtney Fricke is a wonderful investor out of New Orleans, and she did an entire YouTube series and asked probably 30 to 50 very seasoned investors what their mindset is around paying off rentals. I'm going to go find her YouTube channel and post it in the comments. And there are people answering. You have Peter Fortunato answering. You have Bill Cook answering. Jim Ingersoll's answering. Tom Olson's answering. These are, really big people in the real estate scene answering, would you pay off your rentals and why? And that is a great place to go to figure out from people that are way wiser than Tiffany and I, or at least longer in the business than Tiffany and I, on what their mindset is. And just because Tiffany and I say to do something, or Leon Johnson says to do something, it's not necessarily right for you. Find out what is right for you and what is your risk tolerance. Yeah. I feel like it's a very personal question.
It is. I mean, it's one of those, money is not necessarily math. It's not black and white, and it's what you're comfortable with. For us, I sent it as a text message.
Okay.
For us, we want to balance risk and cash flow. So it's interesting because, like, I think a lot of people assume there's more risk in having debt on their properties. But to us, if we get sued, I'd rather show that we have debt, because then they're not going to come after us as heavily. And that's where the umbrella insurance comes back into play there. So for me, even if we had a property free and clear, I'd probably have a trusted friend record a deed against it to That's not the demo link. Do you want the demo link? Is that what you're trying to share?
Mm-mm.
Okay. So that the link Eric just posted is to sign up for REI Hub. If you want the demo link, just send me a DM on Facebook and I'll get it to you. I lost my train of thought. But I think it's just personal on whether you pay off. We plan to have something recorded against our properties just as like a backup. I think also given our age, we're okay with the debt. I think as we get older, we'd probably rather have fewer properties and less debt to have that higher cash flow. But in our 30s, like we'd rather get that higher return because we have such long recovery time and want to compound the rates. So as we build up cash, going back to the original, let's see.
There you go.
Okay, so going back to this view, 6 month of emergency fund is here, and then you're living your kind of happy steak life. From here, 2 years of your expenses invested is a pretty comfortable place. I think as real estate investors, we look at it a little bit differently because this is kind of what someone with a W-2 investing in the stock market would most likely look at. But once you have that investor level where you're covering your annual expenses and you have excess from there, that's when it's a different strategy. Is it, do you pay off the debt or do you go lend and not have to, you could buy more houses or you could lend. It's all in what return you want to get, because for us buying houses, our cash on cash return was 40-50% a lot of times because we were doing true burrs. If we lend, we could get 12%. So it's like, what return are you looking for?
Right.
I think comes into play too. And how much do you want to work? I mean, part of the strategy I think in paying down the debt is if you could have 10 free and clear houses or 20 that are leveraged, but you don't want to work, then I would, go 10 free and clear. So there's so many factors, but it's just finding what works for you and, the strategy that works. I mean, talking about Pete, like I know Pete's never had insurance on his houses because he's always used private money lenders, and he's had one claim in his however many years Pete's been investing, longer than most of us have been alive. And he's had one claim and he just got a loan on one of the properties to cover it and then let the tenants pay it down. So, I mean, I think once you get into that step 7 and 8, you're kind of playing Monopoly at that point, and it doesn't matter. It's just personal preference.
Yeah. So there's 2 comments now. Finding a trusted friend. So
yeah.
What are your thoughts?
I mean, let's just use Josh as an example. You've known Josh since you were what, 20?
Yeah, I was 21 when I met Josh.
Okay, so you've known Josh for a very long time. Josh has seen you make a lot of stupid decisions and a lot of good decisions.
He has.
So let's say we have a house that we pay off. We have our friendly rich friends that give us lots of money. So we pay them off. Now we have this free and clear house. So we call Josh and say, hey, we have this house free and clear. We don't want to actually put debt on it, but we want to record a deed, a lien on it. So
we want to cloud the title.
Yes.
With a mortgage.
Yep. Security deed in Georgia.
Yes.
So we call Josh. We get Josh to sign a piece of paper that says we took out a loan. We don't actually take out the loan, and we record it. It's risky because Josh could say, hey, you jokers haven't been paying me, and he could foreclose on us. So hence very trusted friend, someone that Eric's known most of his life. Gotta share this. So I mean, there's risk in it, and you want to make sure it's someone that you very much trust. But if someone sues you and they do a title search and they see that Josh owes 90% of the house value on a mortgage, they're not going to pursue it as heavily as if they see a free and clear house, is the logic.
Until now that this video is
we're not doing it. So
This video is now on YouTube and Facebook for everyone to see, so that we'll have to find another method now.
Right.
But it is something that can be used very carefully. And like Tiffany and I are saying, we are not tax experts. We are not financial experts. We are laymen's. She's a financial expert, but nothing certified.
Well, yeah, educated. I don't have a license. And it's stuff that we've just heard friends talk about over the years. So I would just say, like, have it as an idea in your toolbox and then research more of it instead of just saying, hey, someone told me to do this, like we did with some structuring stuff, and then had to unwind it.
Right. So James asked a question: are HELOCs a way to cloud a title if you don't draw from the HELOC?
I'm pretty certain it does.
I believe what they will do is they will use however much you're allowed, that clouds that title. So there are official ways to do it, but with a HELOC, you're still going to be paying some fees to set up that HELOC. So know that is a very by the book way to do it.
Yeah.
But it does come with a cost.
It's probably a lot less risky than trusting Josh with houses.
And Silken, you could get a release at the same time that that you get that you're both holding a sheet of paper. It's just, if they record, you record. Right. So if that friendship goes sour, you both have, you have an exit. So that helps a lot.
Yeah. It's just, this is like the fun stuff that comes up on the real estate investor cruises, and you're like sleep deprived and like, what if we did this? And it's like, why? But also like could be a good strategy. So. Right.
All right. Are there any more questions that we might get rolling in here? We could talk about anything, y'all. I'm an open book.
I like this question.
All right.
It was also the next question I read. So, weighing scaling versus optimizing what you have. I think it's a yes and. This is the analysis we do once a year that we started doing last year. So it's not like we've been doing it forever, but we did a return on equity analysis. And that's where we realized, we could sell these two houses that are kind of crappy houses in Noonan and 1031 into some kind of an Airbnb. And ergo the saga of the Helen properties.
It is the saga.
But we make more on it than we would have ever made on those two properties. And we increased our equity.
Yeah.
So it didn't take extra cash. Well, I think it might have taken 10 grand, but it was not a lot of extra cash. So I think you have to know what you have. I know we did an analysis and we have a couple properties that are making 3% return on equity. So we could technically sell those houses and take that cash and go lend it and make more. But we'd lose depreciation. They're solid houses that we don't really want to get rid of. I think there were some hefty repairs last year that kind of offset that, and some vacancies and stuff.
Yeah.
And we're hitting a stride where a lot of our rentals have tenants for like 4, 5, 6 years. So, I mean, the house we lived in when we first got together has the same tenant. So you have to weigh all the things. Don't just look at it in black and white and say, oh, this has a 3% return, because there's so much more to it than just cash in, cash out. But I think it's, continue to scale, but also optimize what you have.
Yep.
Dakota asked about velocity banking. I have researched it. I don't remember exactly what it is. If you want to come in onto the webinar, you definitely can, and we can chat about it. Do you remember what it is?
I don't.
I know I've looked into it. While you're looking at that, I will. James asked about what if scenarios in REI Hub. I feel like there was a way to do that in the past. I didn't see it, just briefly looking. But I want to say there was some way to run those. I know their support team is great. So if you're doing a demo of it, they can definitely chime in and help you out. All right, scrolling the comments. Okay, so Josh was saying he's using chat to help with his bookkeeping. Love that. Eric's done the same thing and had a field day.
Yeah, it was great. I was able to. I did a horrible job of keeping records of who I'm 1099ing and how much, and figuring out what checks were written to who and how. And I just downloaded all 12-month bank statements and put them right in ChatGPT, and it told me who I paid, what vendor I paid, how much I paid them throughout the year.
That's
I
not
used
his
it.
question. I just reread it. And
Well, I was
totally,
just
yeah.
just saying I use ChatGPT
so-
with financials sometimes.
Yeah. Yes.
Anyways,
so he's saying it's software for the entire business. So your ChatGPT, your REI Hub, like Rent Ready, whatever software you're using, where do you put it? You can absolutely put it against the whole portfolio. There's probably like software as an option. If not, others should be fine. I mean, what I love about REI Hub is it's made for real estate investors. So it looks at it as a Schedule E. When you're using QuickBooks or like true accounting software, it's not going to bucket them according to how they want to see it on taxes. So on our Schedule E's, we have, I don't know, like 5 of them one for each property, and there's 3 per Schedule E. And then we have a general property, like general, on the Schedule E. So you have like 1, 2, 3 Main Street, 3, 4, 5 Main Street, and then general as the third one. And it is all the expenses that don't necessarily go to a specific property. So if we go to get El Ranchero, get some Mexican food, and we're talking about the portfolio, we would expense that to that other general property in the books.
So Velocity Banking, essentially using HELOCs to help pay down debt faster. At the end of the day, I mean, so HELOCs are very unique. Some of them are fixed rates. Most of them renew at 12 months. So be very careful about which kind of HELOC you're using to essentially roll over debt. Maybe you're trying to roll over, high utilized credit cards to increase your credit score, and you're trying to roll all that into your HELOC so that you're paying a less interest rate. And because it's spread out so long, that your payment is lower, so your DTI is a better number. It's one of those, how can you make the numbers fit what you're trying to do, especially when trying to, qualify for a mortgage or something like that. But in my opinion, Velocity Banking is just moving debt around. It's another way to think of it in my mind is if you're trading into a better interest rate, do it. But is that interest rate locked? Is it secured? Stuff like that.
Well, so I do remember this now, and thank you guys for the refresher. It's using the line of credit like your checkbook. So, I mean, there's checkbooks right here. Let's pretend this is a checkbook. It's not. It's a St. Jude. Lovely little notepad Eric got. But you get your HELOC checkbook, and you're paying your personal mortgage, you're paying your credit cards, you're paying everything, and then your paycheck goes into the HELOC too. So the idea is you might get your check on the 1st and the 15th of the month, just for example, and you're paying some expenses throughout the month. So you have that pay down from the paycheck, and then you write the check for the expenses. So the idea is that you're paying less interest. It's going to be lower interest than credit cards. I personally, when I looked into it, I thought it was cool, but also sounded like a lot of work to keep up with. If I'm going to do some funky finance strategy, which we generally avoid because it's just, we've got 2 kids and 1 on the way. We don't need to complicate things any more than it already is. And pregnancy brain is a legitimate thing. I would do credit card churning. And that is, when I signed up for our Chase card, we got a $500 bonus when we spent $3,000 in the first 3 months or whatever it was. So I would open new credit card accounts, get those bonuses. And if you can, the 0% interest. This is how Eric and Tiffany funded buying rentals for a long time, getting credit cards and maxing them out, paying for Lowe's and Home Depot. We used our cash from our investors or the money that we had to pay the contractors. And then we would do a BRRRR, cash out refi, pay off the credit card, start again.
Yeah. And then when that ran out, we would get a new card.
Yeah.
Yeah.
Get the $500 bonus, get the 0% interest for a year, and then keep going.
Yeah.
So to me, if you want to travel a lot, I've heard like the Southwest card is a really good way to get a companion pass for free. So I have a friend, she flies back and forth across the country all the time and uses that hack to fly her family with her.
Mm-hmm.
So personally, like velocity banking just sounds more complicated than my brain can handle.
Yeah.
And if I'm going to do anything, it's going to be the credit card.
The most complex, weird thing we do is infinite banking, but we're more or less just investing in it right now and not utilizing it just yet. It's one of those, it will come type things.
Yeah.
So.
We set up one policy. I have a decent grasp of it. We have friends that are very wealthy that do it. And it's just kind of one of those, I don't know that I fully understand it. It's whether you use the whole life policy or not, it's a way of thinking. And the idea of the infinite banking is you are paying yourself back interest for everything that you buy. So if you pay cash for a car, you are either going to pay the bank interest or you're paying yourself interest. So when you buy that car, you amortize it and treat it like a payment to yourself and rebuild that account. And Dakota made a joke about Dave Ramsey, which I love Dave Ramsey. It's some good no brain entertainment for me.
Can be. Yeah.
When he starts yelling, that's when that's really fun.
Yeah.
The idea is, let's say you go out and buy a $20,000 car tomorrow, and you know that in 3 years you're going to want another $20,000 car. You, in theory, should set aside money every month to cover the cost of that car, so that in 3 years you can buy that car, and it's not a financial hit. So infinite banking, the premise would be that you would pay that monthly payment plus 10% interest, or whatever the deemed interest in your mind should be. And that's how you grow the wealth. It's a saving strategy at the end of the day. And that's super simplified. I can connect you with our team that knows tons and tons and tons about it and has all kinds of free education. But it's something we've started. We aren't full in on it yet. We could make some moves to be more invested in it.
Yeah.
It's just not, again, back to brain power. It's not a strategy that I want to invest in this season of life for us.
Yeah.
But as we get more, stable in our family situation and stop having kids, then
we're done after this one.
Yeah.
I think
that's the plan.
Yeah. So there's people on Facebook and on YouTube. So the Facebook people can't see the YouTube, and the YouTube can't see the Facebook. So that's why we're bringing a lot of these comments up on screen. I think
we've addressed all of these though.
Yeah. So this one was from Dakota. He knows enough questions, right? And we did address that.
These are all on velocity banking.
Yeah. Principal payments out of the line of credit. Yeah. And I'm just going to show a couple of these so that, crisscross on the platforms, people can see the comments being made.
So James was saying with the 60-day notice, the bank can make an update on the rate on a HELOC.
Yeah.
We have a great bank that we've used for a HELOC.
Yep.
And it was the easiest process. And I think they only did increases once a year.
And we were funded within 3 to 5 days.
Yeah, it was honestly a little nerve-wracking how easy it was to get that loan. I will say we still had W-2 income when we did it. Yeah. So that made a difference.
Yeah, and I think they used a BPO on the appraisal. So and that's
no, on that one, it was Clark Street, and we had just done a cash out refi.
Okay. Gotcha.
So we just sent them the prior appraisal.
And who are the people? That was Connexus Credit Union. I think they're out of Wisconsin. Yeah, that was Connexus. Connexus. Yep. So just some more things, amortized interest versus the daily average interest.
That's
when talking about the velocity banking. James talking, keep in mind the money that you use to pay the HELOC or other bills is after tax. And that is a great point to make.
Here's a fun strategy. And I think I saw a comment around this earlier, but one of the things I've learned from my coach is pay yourself whatever the amount that you deem you should be paying yourself each month. So let's say you have enough rental properties that you feel comfortable that $5,000 a month is what you should be able to pay yourself every month. Pay yourself that $5,000 every month. And if you have a shortage and need to fund more into the business, do a transfer into the business as an owner contribution and then charge, well, as an owner loan, not a contribution. Sorry about that.
Yeah.
And charge yourself interest. And then you can write that interest off. So if you make a $10,000 loan into your business, you can charge yourself interest and pay it back to yourself.
Yep.
I've never thought to do that.
Great strategy.
Yeah.
Just some more things. The Dave Ramsey inside of Dakota is cringing right now. Silken saying her and, oh my gosh, Richard. I blanked on his name. Her and Richard are recovering Dave Ramseyers.
Yeah, pregnancy brain.
Yeah, and I did post in here the name of that credit union we used for the HELOC. We have not used them in a long time.
Yeah,
but that is who we used.
Yeah, it was easy.
Yeah, easy
also
peasy.
Got camper loans from them if you want a loan on a camper.
Yeah, we've done some crazy stuff. And Dean, thanks for the shout out. Good memory, Tiffany, on getting back on Velocity Banking. Yeah. All right, y'all. Well, we're hitting about an hour. So if there's any further questions that you have for Tiffany, I'm going to put her email here in the comments. Please send her your questions. And if you have anything that you want to follow up with her on, or you want to set up a consultation call to just talk through your books, to figure out, can she help you in your business? You reach out to her at Tiffany@energeticcfo.com, and she'll probably set that up quickly.
Yeah. Got a Calendly link. Makes life easy. I forgot to.
EnergeticCFO.com. There it is.
Adam asked, do you need a W-2? I think it's easier to get a personal HELOC when you have income, like legitimate income. When you look at our tax return, people are like, how the hell do you survive? So I would say it doesn't necessarily have to be W-2. I think that made it a lot easier, but documented 1099 income is going to be easier than like real estate investor income. Just my experience with banks, but it's worth a conversation and asking the question.
Yep. I put Tiffany's email in there and a link to her podcast and website. You can also book a call on her website. All of her links are there. So yeah, Adam, I'm with you. I haven't had a W-2 since 2018. So super happy about that.
You bum.
Quite the bum. It only gets in the way when it gets in the way.
Yeah.
And usually that's not a lot. Unless we're looking for HELOCs and stuff like
Right.
that. And then that's where it's nice to have friends that trust you,
Yeah.
that trust your business practices, that trust your valuations on your properties, especially when you have, a property that surged in price in 2022 that you bought in 2017 that has $170,000 in equity to get you to just 70%. And you say, hey, I need a line of credit. And they're your bank instead of trying to qualify for a bank.
Yeah.
And if you're like, wow, that must be nice, Eric, listen, you can do it too. The best time to buy a house was yesterday. The second best time to buy a house is today. So it's just stop getting in your way. Make those massive imperfect actions and learn along the way.
Yeah.
You can make it. You can do it.
We have great agents in the deal maker community as well. So if you're looking for someone to help you find deals, post in the Facebook group, and I'm sure they'd love to help.
Absolutely. All right, y'all. It's been great. I've had a great time. I feel like we're podcasting again.
I know.
It feels like we're back in that little barn at Clark Street in our little chairs. If you go to the first 10 episodes of the On Purpose Investor podcast, you'll see go to the YouTube and watch those videos. We're just sitting in the little barn.
Yeah,
I put a mini split in. And
quite pregnant.
you were pregnant
So
with our
friend.
You were pregnant with our 4-year-old then. Yeah. We can't do videos without her being pregnant.
Yeah, apparently.
What did we learn?
Right.
All right, y'all. Thank you so much for joining us tonight. And don't forget, March, Josh, if you're still on, if you could remind us the date of your presentation in March. In So March 13th, we have our in-person meetup, Dealmaker Atlanta at the Holiday Inn West, Camp Creek Parkway. And that we are doing a presentation. I'm not doing a presentation. We invited the fine folks from Nosotros, North Atlanta. They are going to be coming down and presenting on how to invest in mobile homes on land in Atlanta, how to flip property, how to flip land with a mobile home on it. So it's investing in mobiles, investing in trailers, however you want to call it. They're going to teach you everything you need to know about funding the purchase of the land, funding the purchase of the mobile itself, connections for finding mobiles. Some mobile manufacturers are like 6 to 12 months out on delivery, but they have better connections. So these are the type of people you want to come watch. Invite a friend. First meeting is free. So if you want to invite a guest that has never attended, please come and join that. And then the following week, Josh is going to be presenting March 18th at 7 p.m. Commission to cash flow. He's going to help real estate agents switch their mindset to investing. So if you know some agents, please invite them over. There's going to be a link just like this was tonight. We're going to stream into YouTube and into Facebook and invite all of your agent friends to come ask their questions. All right. Did I miss anything?
I don't think so.
All right. Thanks for joining us, y'all. And we'll see you at the next Dealmaker Atlanta event.